taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, welcome back to another episode of Total Money Management. We're going to be covering off the week that was, March 4 to March 8. I'm here with Jacob and Steve. How are we doing, gentlemen?
Good. I didn't know if you were bringing us in or not. I thought Tom's working on his own today.
I haven't had my fourth coffee, okay? Just go easy.
Hello, I'm here today on my own.
The fellas are flying solo, back of the rest of them. Righto.
How you going, Tommy? You good?
So far, so good. We'll see. If
You've
you
been
keep
away.
ridiculing me.
Where have you been this week?
Oh, I was away for work.
Oh,
I'm not saying. Can't say,
nice.
mate. Can't say.
Secrets.
Can't say. Absolutely. No. Look, got a lot to cover off today. As we touched on last week, the theme of the week that was is kind of to reaffirm the thesis of the 4 Cs and just, kind of cover off how we believe times are changing and therefore our approach must change as well. Lots of exciting stuff to touch on. Biddy hit 70K US last night. Jacob, how you feeling about that?
It's been a blinder of a run. It's been good across every market, though. I was looking at the S&P. That's at new all-time highs.
Hallelujah. Thank God you said that.
Everyone's absolutely...
You bloody Bitcoin blokes. Oh, it's going gangbusters. Yeah, mate. So it's real estate, the S&P, two flies racing up a wall.
Steve's salty. He didn't buy Bitcoin.
Steve's just jealous.
Mate, listen, well one's doing all right at the moment too, gents. Don't worry about that. And there's a lot less risk in that shit you buy.
Yeah, you did right. I was actually looking at the well 2 and 3 spreadsheet that you sent through.
Yep.
And that's looking pretty good as well.
It's not too bad. The tricky part is, and this is why we got the 3 wells, because you look at well 3, in 3 months and you go, oh, that's all right. And it's like, yeah, but you're not getting the money for 30 years. Yeah. It doesn't matter what happened in the last 3 months, Whereas that's why well 2 is about saying, well, we're going to make a money over, 1 to 5 year period, and well 1 is we're going to make a sort of income sort of thing. And that's why you can make money over different time frames, and that's the important part. Because, like I say in well 1, if the CAPE ratio like it is at 35, you might have a 50% holding in cash in well 2 and well 3.
Yes.
But well 1's making you money, right? So if that's the case, you go, all right, well, that's fine. I'll just, my long-term compounding will come in well 3 when, Australian stocks go really dirt cheap. Then I can put a lot of money in because I can't get it for 30 years. Therefore, I'm happy to wait for a really, really good pitch, right? Yeah. Whereas in well 1, if things look a bit dodgy, you go, okay, well, I'm going to step straight out.
You can get in and out. And well 1's the sexy one, right? I mean, I get people ask me all the time, oh, how do I quit my job and let's just do well 1? I'm like, oh, hold on a minute, fella. Have you ever invested anything before?
Yeah.
There's a few moving parts here.
It's not rocket science, but you got to understand it firstly. But that's the sexy one, right? That's the one people want to go, oh, I want to do this and I'll make 300-400K a year.
Well, it's for a certain type of people. If you're really interested in investing, you look at it, you look at it every day and you think about it and you read books about it and all that sort of stuff. If you then say, Tom, what you should do is adjust your superannuation like this, you go, fucking hell, is that it? Yeah. Like, geez, that's not very exciting. So what do I do now,
But they told
Steve?
me it was hard.
Well, but it's also, you go, now what do I do, Steve? It's like, nothing. You just sit there and wait. And it's like, is that it? But I'm really interested. And it's like, yeah, but you get long-term compounding returns, right? Whereas if you swing to well 1, you can do stuff every day. And, and I find most people really like well 1. I shouldn't say most people. There's a certain cohort of people who do well 1 and go, this is fantastic because it suits their personality. I love looking at it every day and I love doing a little bit of stuff. And
because it makes a lot of money. You get to do something every day.
Well,
it scratches that itch.
And you don't have to go to work.
Yeah, exactly. But that's really important, Tom, because if you don't have a strategy that fits your personality, you're going to stuff it up by day trading well 3. Right? Yeah. Or something like that and going, no, that's not the way you do it there.
Can you day trade your super?
Don't even get, not financial ever.
Well, you can, I do well 1 in my super.
Yeah.
Right? Well, I'm over 60, so I don't pay any tax. So that therefore the incentive for me is I can sell every day or every week and not pay capital gains tax.
Interesting. Well, I was just going to say, there's a certain type
Strike
of...
one for the boomers.
Another one. You want the house? You got all the houses as well.
Let me tell you about the house I bought in 1982.
It must be nice up there in his ivory tower.
You suckers are just buying that Bitcoin and...
Oh, again.
Well one works well for Bitcoin, just saying.
Well, it does, yeah. No, that's true because of the volatility, right?
Yeah. Well, I was saying that there's a certain type of personality that come and have a chat with us anyway, right? It's the people that want to move forward in life. They've got goals. You rarely get the people that are not interested in finance coming to talk to people that talk about finance. Every day.
Yeah.
So,
but you raise a good point, Jacob, because what you hear a lot of people do is say, "Oh, you got to start your own business, right?" Okay, all right. The success of starting your own business is being really profitable is really, really low, right? It's under 50-50. And that's because there's lots of competition, all sorts of, you hit a recession, you go broke, you run out of capital, all that sort of stuff. It's really, really tenuous. And what we say is, what are you doing a business for? Okay, I'm doing it because, I want my own freedom. Okay, well, that's cool. But I want to make money. Okay, we can say to them, okay, if you study investing and you invest the surplus money that you make, even in a day job, right? If you invest that money properly and we show you how, that's your second job that you don't even have to work hard at. Right? And that's like you say about Well One, Jacob. Well One is saying, well, hang on, I'm making this money and all I'm doing is clicking a button. Yep, that's it, right? But it's not risky compared to saying, oh, I'm going to have a shot at buying a coffee shop and, gee, I hope I make it, and if I don't, I'll lose $100,000. Yeah. Right? Well, you can do that. Okay, well, but that seems really risky to me. Right? But if you show people Well One or, even Well Two and Well Three, people go, oh, right, okay. And that's why I say it's not hard. It's just understanding how things work and being interested in it.
Yeah. It's even like the first thing when you start looking at investing, right, and you get your head around the concept of compounding, and then you go, right, okay, so if I can compound my money at 15% a year, which is obviously utopia.
Absolutely.
You go, oh, my God. That number's mind-blowing.
Yeah.
Whereas,
I'll have 5 million in 5 years. It's like, okay, best of luck.
No, well, look, maybe. But, if you take kind of that view with your super, I think that's why Well 3 is probably the most important. Like, no one wants to be in a position where they have to rely on it, but I think it's a solid plan B.
Yeah.
And when I was kind of playing around with those numbers, it's like, well, if you rely on the way that the funds have been performing, it's easy to see how people get to retirement age and go, this is a problem.
Yeah.
Whereas if, someone who's young now pays a bit of attention, like you said, it doesn't actually take a lot of work to outperform what your fund's going to do. And it's going to make a huge difference
It literally
20,
takes
30 years down the line.
a year to get it right once you understand.
But worth looking at.
So you start. I'll say our age because no point starting at your age. Joking. Start at any age, but you start when you're young, and the compound rate there is just astronomical. By the time you get to 67.
Yeah. But that's why I say if you start at the right time, and I think I sort of harped on this a couple of weeks ago about residential property. It doesn't matter what you bought in 2000, guys. You did really, really well, right? Because you had falling interest rates, lots of credit. A whole raft of conditions that regardless of what your talent, you just bought property and it went up, right? Now, I'm not denying that some people have got talent in buying property, right? It's the same with stocks. But what I'm saying is if you buy low and it's a long-term secular bull market in property or stocks or bonds or whatever, you only need to do it once, right? Because the compounding is generally positive over that cycle. So if you look at 2009 to today, the compounding has been about 14%. Now this is, believe it or not, a fairly standard sort of bull market. That's doubling your money every 5 years, right? So if you start with 100, you've got 100 to 2 in 5 years, to 4 in 8 years or whatever it is, and then to 8, right? So you've made an absolute bucket load of money. And it's purely by saying, I just bought when the Cape was at 13 or the market had collapsed, right? And if you find property markets like that or emerging markets, or like you were saying, Tom, in Well 3, if you go, wow, like gold is really cheap on a historical basis, okay, I'll put more money in gold. That's where you start to see the compounding returns, right? That's again, what we always say is about the patience and waiting for the fat pitch, because it makes such a difference, right? If you look at, and I think I talked about this a few weeks ago, we've had superannuation now in Australia for 30 years, right? Okay, annual returns, they reckon are 8%. Great, where's all the millionaires? Where are they all?
If it was really 8%, everyone would be a millionaire.
Exactly, but it's not 8% because you've got inflation, you've got volatility, you've got taxes, fees and charges, and as we say, it ends up being around 2 or 3%. Well, if that's the case, it's
double your money every 30 years.
36 years, right? So, and that's what I mean. People get misled into thinking that they're going to retire rich, and that's why we're saying, no, don't do that, because, you've got to work at it. And if you invest actively and know what you're doing, you'll make a lot more money than people who go, oh, I'm just going to believe, the mainstream media at 8%. It never works out to 8%. It works out like in the US where, 2000 to 2010 was basically zero, and 2010 to 2020 was 14, right? Half of 14, 7. Okay, well, there you are. You're close to 8% annual return over 20 years, right? That's what people have got to understand about compounding, buy and hold, what your approach is, all that sort of stuff.
Yeah, and you've mentioned it a bunch of times as well. It's the volatility that ruin your returns as well. If you have a few good up years of anywhere from 8 to 12, 14%, and then you have a down year of 35%, well, you're a scratch again.
Yeah.
So,
Yeah.
Anyway, what's going on this week? It's been a big one, March 4th to March 8th. We've got a little bit on government involvement in the economy that continues to grow through just the development of industry policy. I know you've been doing a fair bit of research on that, Steve, so you might want to expand in a little bit.
Yep.
And then we've got everything down through to a nice fancy chart on Buffett's, not fear and greed index, just the Buffett indicator, which is showing an overvalued market, which Tom rightly said just before this, we'll share on the socials and just give people a bit of an overview of that and everything in between from birth rates and how that affects the economy. So let's start working through it, gentlemen.
Away we go. Well, I just want to mention that government involvement, and again, because of what you said at the start, Tom, which is we're trying to give people this idea that the world is changing, and you've got to invest differently to the way that you have. And I think just before we came on, we were talking again a little bit with the Buffett stuff, but also about book value and earnings, right, and the differences. And so that's for another time. But the government involvement is about where capital, right, where money and where investing will go.
Or where governments are spending, right?
Exactly. And so I don't think I put it in, but there was, I think it's an article there where the Europeans said we need to get on to a war footing economy, right? And now that is, people go, oh, well, that's interesting. Well, too darn bloody right it is, because what Europe is saying is, listen, we will start controlling where the capital goes rather than letting the markets decide.
Yeah.
Everyone wants to buy widgets. Cool, let them invest in a widget factory. No, not anymore.
Sorry, what is war footing?
A war footing economy, a war footing economy is an economy you have when you're on a war footing. Okay, what is a war footing? A war footing is saying, listen, there's a big chance of war. Okay, what do we need? Well, we need to build a lot of bombs, and we need to build a lot of bullets, and we need to buy tanks, and we need to buy submarines, and we need to buy aeroplanes. We need to do research and development into lasers. We need to protect undersea water cables because the Russians are down there trying to hack them, which they're doing, right? So that's what I mean. We are not in a global world where we are all friends. We are now in a hostile environment, right? And that's why I'm saying to the younger guys like yourself, it's not the last 30 years where you boys have been raised going, oh, this is cool, you just buy the dip and you make money. It's not that world anymore.
We're going to put the leather boots on and get in the trenches by the sounds of it.
Well, they've raised the issue of conscription.
Yeah,
right. This is what goes on in a war footing, right? Shit. You get politicians. There's a few in the US. There's a few somewhere else I can't remember. But there are countries that have conscription. right? And that's what I mean. That's where things you look at and go, oh, geez, this is a bit serious. And that's why, Joe Biden is spending billions subsidising semiconductors built in the United States because they're a key component of weapons.
Yeah, it's interesting what you said. So it's basically a reorganisation of where the cash flow is going from the government, and it's going from free market and people being able to build and buy what they want to, all right, we're going to pump a boatload of cash into things to build boats, build
defence
tanks,
industries.
Defence.
Yep.
So why we're talking about that is because we might look at companies that are building those things, or
Exactly.
We'll follow where the capital is going. Okay, which companies here are cheap, and what can we put some cash into over the next 10 years or so?
It's the capital cycle theory.
Yeah.
Right, which we teach in Well 2 and Well 3. Okay?
Yeah.
Where's the capital going? Like, if you look at the last 2 years or 18 months or so, there's been a huge boom in lithium, right? Why? Because all the capital is going to lithium mines, right? So what do investors do? Momentum investors all jump into lithium and ride it on the way up, right? Now, what did it's crashed like 80% or something.
Well, that was for EVs, right? Was that EVs that it pumped that?
Yep.
Yeah.
EVs and all that sort of stuff. So, again, that's the capital cycle you've got to watch, because previously, and as we were talking before, everyone's been hot on IT for 10 years. Well, that's going to change now, right? Because we're not really interested in Facebook. What we're interested in is building bombs, and that means we don't want to buy Meta on a PE of 50. We want to buy Lockheed Martin on a PE of 20 with good growth prospects.
Unless Facebook starts building bullets. Which it probably will.
Yeah, wouldn't be surprised. I mean, there's an article here. So the US uranium enrichment industry is going to get a $2.7 billion government infusion.
That'd be nice, wouldn't it?
Which reflects efforts to wean the nation off nuclear fuel imported from Russia.
Yeah. And that's what I was saying before, right? You've got this stupid economy, global economy, where the Americans export stuff to Russia and China, and then Russia and China export stuff to America, and they're building, like, they can't build bombs without each other. Like, it's just madness, right? China does all the processing for rare earths, sends them to America. America goes, thanks, we put them in our bombs, and where do we aim those bombs? We aim the bombs at China.
I think we've almost used our China quota up today, because I feel like we've probably used the annual quota up over the last few episodes. But they did announce on Wednesday they're going to focus less on property as a mean of growth, and they're going to focus more on advanced manufacturing. So, I mean, that just further reinforces that trade war, right?
With Evergrande going down the pan, they're basically going, oh, we're not doing this anymore.
Yeah.
We'll focus elsewhere.
Well, you see, Xi has worked out that the Americans are not going to play ball, right? So the Chinese have been relying on US technology, right, and importing it and stealing it, take your pick. But now the Americans have said, no, there's semiconductor ban on China, right? So the Chinese can't say, oh, what we'll do is we'll just continue to, do property. The Chinese are saying, well, hang on, now we've got to build our own semiconductors, right? Well, we really need to focus on advanced manufacturing, right? And so that's the flag of what I'm saying is there's more government involvement because there's now a hostile relationship between China and America, right? And Europe and China are now becoming hostile, right? I think I put in something there on the Europeans saying they're now going to look at products that come from, the human rights abuse areas and all that sort of stuff, right?
Yeah.
Europe is looking at Chinese EVs, right, because they're heavily subsidised. America came out and said, we need to have a look at these EVs because they can generate data back to the Communist Party government, right? So you can, look, I might be wrong, but you can see what's coming. They're going to say to them, look, this week Biden in his State of the Union speech said, I want to ban TikTok in America. Why? Because the Chinese get all the data. Data is the new oil sort of thing, right? You need data. And so then you can decipher what's going on. That's why Americans last week said no more Chinese-built cranes on the docks, right? Because the Chinese can tap into all the data. Now, if China was a democratic country, there might be less of a problem. But the problem is China's a communist government, right? And they're saying, well, we want to piece the data for national security and, all sorts of stuff. Well, the Americans have said, okay, enough of that. That's over. So we're going to stop that. You can see it coming a mile away. All they're doing at the moment is just decoupling slowly so that neither side sort of gets hurt. But both sides know what's going on. And that's why I say we're not going to wake up tomorrow and go, oh, silly us, we're all friends again. That ain't going to happen, right? That's not the way history works. So that's why I say investing is going to be a lot different. It doesn't mean you can't make money, but it's just going to be a lot different from what we've been doing for the last 20 years.
No, it's good to just think of that capital cycle theory and have that in the back of your mind and go, okay, there's all this nonsense going on, but let's just follow where the money's going.
Yeah.
From an investor perspective, everything else you're like, oh shit, the world's ending.
Yeah.
But from an investor
when you think about all the other stuff, you're going, wait, is investing really what I should be focusing on right now?
Absolutely.
Yeah. Oh, yeah. Look, it should be.
The world's going to end, but I'm rich.
Well, but what I can tell you, from the 70s, we were all worried about nuclear war. Right, they have the 1 minute to midnight, all this sort of stuff. And generally, you have to have faith in humans to go, well, I hope one of those dickheads doesn't pull the trigger, and then we got really, more to worry about. But the point being, you've got to look at it positively and say, all right, well, it's no good getting 30 years down the track and going, oh my God, I worried all that, and now I'm really poor. You're better off saying, well, if we're going to live in this world for another 30 years, how do I invest appropriately to make sure I'm, keeping up?
Yeah.
And that's really what it's about. All I'm saying is if you look at history, these things cycle. We're now in a new cycle. And so it doesn't mean the world's ending. It just means the world's changing.
Yeah. Bit of a paradigm shift. Someone will put their sensible cap on one day and it'll be fine again for a bit.
Well, it's just bargaining, Jacob. You see, everybody's run down their military spending because we've been in a friendly, globalised environment, right? So lots of European countries went, it's all great, we're buying gas off Russia and, they're not giving us the shits anymore and they're not carrying on. That all changed when Putin in 2014 said, I'm going to Ukraine, right? And that's when that was the game changer.
And that all links up with the US manufacturing construction spending, which has gone up by 130% in the last 2 years as well.
Exactly. You see, now you're saying, hey, listen, we can't get that stuff from China anymore. We got to get it ourselves, right? How do we get it ourselves? Right, we've got to build it ourselves. How do we build ourselves? Right, we've got to put incentives. The market doesn't incentivise that.
It's got to come from the government.
Exactly, because the market said, no, mate, we're building in Taiwan where it's really cheap.
Yeah, market wants to go where the money is.
Exactly,
So,
exactly. And that's the perfect point, Tom, because what I'm saying is those days are over, right? The Americans have now said, right, we're going to start, as I said, Biden's State of the Union address, he was saying, we're going to be building it here, it's going to be made in America, blah, blah, blah. That's the rhetoric you have not heard for 25 years.
Interesting.
Right?
Look, moving on, we've got a couple of interesting charts to talk about. The next one, this one's just highlighting small caps versus large caps, right? Large caps have obviously had an unbelievable run. Looking at this chart here, you can see from about 1980 to 2000, small caps underperformed. Then they had a 19-year run where they went absolutely gangbusters. They've had another 5-year drop. And if we're looking at mean reversion, large caps have been on an absolute tear. So what would you say, Steve?
Yep.
Time to start looking at the small caps?
Yeah, if you look at, again, this is part of the new normal. If you look at the way things operate in high inflation environments, companies with hard assets do really well. So, for example, energy, right? Energy's had a down 10 years, okay. We're going into a high inflation environment? Yep, probably. And I'm talking secular, right? I'm not talking about tomorrow. Small caps do really well in that environment as well. We highlighted in the newsletter last month, I think, or maybe January, that if you look at the 64 to 82 period, I think we're going to replicate that. Now, you go back and say, okay, what did well during that period? And small caps were one of the ones that did quite well.
Yeah,
right?
Emerging markets.
Exactly.
It's in my mind when I look at this chart, Tom. It triggers. Okay, what do I need to think about my asset allocation now? So it's been different over the last 10 years. We're going into, with everything we've just spoken about over the last 15 minutes, a bit of a new paradigm. How do I need to look at my asset allocation moving into small caps, emerging markets, and things that have been underperforming?
Take some profits out of the large caps.
Yeah, take some profits. Have a look at reallocating into something that we're expecting to do well over the next 10 years and just having a bit of a reset. Because you look at graphs like this and then you compare it to like the US construction spend and you're like, okay, well, there's a change. So let's have a look. Is it probable, it's like playing a game of poker, that you're going to keep winning this hand over and over and over again, or do you need to change it up? And I think now is where we're changing it up a little bit. So
Bingo.
For me, that's like, yep, trigger. We need to start having a look over the next quarter or next 12 months to reallocate things for the next 10 years.
If you think, Jacob, this is the thing where everybody talks about long-term investing, right? Everybody says, Tom, you're 30 and you're 31 this week, Tom? 30 or 31?
30.
30. Happy
Don't
birthday.
insult him.
Thank you, mate.
Well, you get to 61, bro.
I'm still in my 20s, so I'm
Jesus.
sitting here.
You guys are half my age. Anyway, now my point being, if you have a think about that, people say, "Oh, you got to think about the long term." Blah blah blah. Well, that's what we're doing. We're telling people things are changing over the next 10 to 20 years. You listen to the financial media, they're talking about shit that's happening next week.
Yeah. Just pile your money in, it'll be all right.
Well, yeah, what I'm saying is if you're thinking long term, well, you've got to look at long term structures, right? Secular bull market, secular bear markets, inflation, interest rates, all the blokes on the bloody radio and the media are gabbling about, the purchasing price index this month. It's like, mate, if you're talking about it, doesn't make that much difference.
It's just noise.
It's just noise, right? But they do that because they've got to talk about something. Mm-hmm. You look at Warren Buffett, he releases an annual letter, right? He doesn't release a letter every week going, oh, this is what happened this week, right? Because he is a genuine long-term investor and his approach is compounding his money over the long term, right? So he looks at the long term. Mm-hmm. And what do you do in the long term? Like I said at the start, buy cheap stocks and hang on to them.
Yeah.
Right? Buy cheap companies and buy cheap countries and hang on to them because you look at it and say, my returns are going to be 12 compounding. That's great.
Yep. Like when you look at what Buffett does, it's simple, right? He goes, I'm looking for good companies that are going nowhere. And then when he's cheap, when they're cheap, he piles in.
Yep.
And when they get expensive, he takes a bit off.
Yep.
And then when they're cheap again, because they'll go out of favour for some reason.
Yep.
He'll put some more in again.
Yep.
And then
that's his
when they get expensive, he'll take some out again.
Well, that's what we teach. We teach the capital cycle theory, and then the session after that is durable competitive advantage.
Yeah.
Right? And it's actually true what you're saying, Tom.
It's frustratingly simple.
But there's so many people who don't, there's so many people who talk about Buffett as if it's like a key word on TikTok or something. So they mention Buffett, but they don't know how Warren Buffett invests, or they love the Charlie Munger sayings, but they don't invest like Charlie Munger, right? Their portfolio turnover is 100 times more than Munger and Buffett.
Well, they know now because I just told everyone.
Well,
Tommy. Thomas Buffett.
You're a bloody genius.
All right, well, we've only got a few minutes left, so let's cover the Buffett chart. And I'll just get closer to my mic so everyone can actually hear me. But let's talk about the Buffett chart at the bottom because it's really interesting. And this new chart of the week thing for me is like my favourite part of this podcast.
Oh, really?
So I think we need to do that a bit more.
Oh, right, okay.
But what it's basically saying, or what I take from this anyway, is that...
Says the marketing director.
Yeah.
Don't mention Buffett, do the chart.
Just do the charts instead.
Do a Buffett chart if you can.
We're currently 2024, this data's up to 2023, but it's at 46% over the long-term average, which means it needs to fall by a lot to get back to where we should be. And the only time that's really been higher was in 2019 and COVID, 2000 through the dot-com bubble, and then 1968, which Steve can tell us about because I wasn't around.
Well, yeah, mate, I was 5. let's not get too carried away.
So it hasn't been much higher.
But that is the relevant period. What happens after that?
Oh, it goes nowhere. It
Doesn't go nowhere. It goes deeply,
drops. Yeah.
right? Okay, so from 64, like I've been banging on about, 64 to 82, the Cape was 25 in 64. It ended up at about 5. What's the Buffett indicator in 64?
58.
And the
58%
two-
above the average.
2 standard deviations, right?
Yeah, yeah.
And where's it end up in 82?
51% below.
Insanely cheap.
Yeah.
That's it, fellas. That's it. That's it. That's all you have to do.
So today, and look, we'll share this chart on the socials just so everyone can have a look.
Yeah.
But this highlights that we're 46% above the average.
Yes. So in other words, the market's got to drop. The market's got to halve.
Yeah.
Right? And now Cape says the same thing, 35 to about 17.
And people will probably raise an eyebrow when they go, right, but if it's only 46% above now,
Yep.
but it was 96% above at the end of 2019 before that COVID dip.
Yeah.
The reason for that, right, is because this is a calculation based on market cap
Yep.
over GDP.
Yes.
And obviously profits were down massively in that period, which is going to throw the calculation out.
Exactly.
Which is the only reason why it looks way worse there. Because you could look at this the other way, right? If you didn't understand that and go,
There's heaps of room.
well, yeah, there's still room to move, man. Like, you know.
Well, there still may be. As I said last week, look, there could,
Of course.
you know, it could go to 80% overvalued.
Well, it's only overvalued now, according to Buffett. It's not strongly overvalued, technically.
But that's what I'm saying is when you look at investing, you say, what's happening to my existing money and what should I do with my new money? Now, my existing money is under threat because
overvalued.
it's probably overvalued. Why, in that case, would you go, oh, I've got $100, I'll put it in? Well, okay, you might do that if you're doing well 1 and you make $200 next week. But if you put it in at well 3 and going, oh, I'm going to hold it for 30 years at 1%, okay, I might sit there in cash and wait until 1982 comes along.
Or you could put your $100 in the market today and it might be $102 in a year.
Exactly. If you look at 64 to 82, you put $100 in 64, you had 200 in 82, right, or thereabouts. Oh, that's a double. No, unfortunately it's not because inflation was 7%. So in actual fact, what you ended up with was like 1%. And that's what I'm saying is coming, right? You've got to read the things in the context of history, but also read them according to inflation, interest rates, what's going on, right? Because as I said to you before, Tom, if I say this property's $1 million, you go, okay, well, is that good or bad? Well, no, I'm just telling you, it's $1 million. It's got to be married to something. If I said to you, Tom, it earns $100,000 a year in rent, you go, that's fantastic, that's 10%. Now you've got a context. If I said to you, Tom, it earns, $20,000, you go, that's bloody awful, right? So just knowing the price of the S&P, which I think is insanely about 5,100, doesn't mean anything. You've got to look at it in the context and say, but what's the price related to? Now, even the current PE is something like 27, which is the standard long term is usually about 19 or 20. So in other words, we're way overvalued. Right, we're way out over our skis on all of these things, and what I'm saying is now, the point is, Steve, does it drop 50% in a year, or does it decline slowly? I'm arguing that we're seeing 64 to 82, which means it's going to decline slowly over the long term, and your returns will probably be eaten by inflation.
Which is disgusting for young investors.
And volatility.
Unless you do something like Well 1.
Well, yeah, and that's what we're saying. If you do Wells 1, 2 and 3, you're covered. Right? Oh, gee, Steve, Well 3's not doing much, but geez, I'm doing all right in Well 1. Yeah. Okay, well, you're doing all right then. The Well 3 will get an opportunity, right? As will Well 2. And so that's the whole point about saying I'm investing over using different strategies based on different time periods. Whereas it's good to look at Warren Buffett and go, oh, Warren's made 20% for, 60 years, 70 years or something, right? But my point is, how many of us are going to be Warren Buffett? I mean, seriously, look at the conditions Buffett started in, right? He was a middle-class boy. His old man was a congressman. He had a bit of dosh. So he started well. He started when American capitalism was on the boom globally. He admits this. He's had a dream run, and he's been born a white guy in America, the richest country in the world. So, if you're a poor African in Uganda, it's not like you're going, oh yeah, dude, I'm going to be the next Warren Buffett. You might be, but boy, oh boy, it's a slog. Yeah. And that's why I say a lot of it. You can educate yourself. Like we trying to help people now, but if Caper's at 35, it'd be stupid if we said to people, look, you should have 80% of your money in the market now. It's like, oh, okay, right. That would
be irresponsible of us.
Yeah, I mean that's one of the reasons why he is, because we absolutely hate those people that are doing that. Well, so we're trying to actually educate people to go actually do a bit of research.
Yeah, well, think if you that's why I'd say if you do it for yourselves, we have the document cost, choice and control, right? Which is saying to people, here's why you should manage your own money. Listen, it's not that hard, right? That's the perception that, oh, you've got to be a financial whiz to manage money. No, you don't. You've got to know we talk about the 8 principles, right? That's what is really important when it comes to managing money. And don't believe the daily bullshit that goes on in the financial media, right? Talking about, you look at every month there's 20 indicators. Okay, well, which one of them's important? Which one should I pay attention to? Oh, you've got to pay attention to all of them. Okay, well, which is the weighting? Is that one important?
Yeah, no, they're all going to contradict each other and confuse you.
Exactly.
Just put your money in the market.
Yeah.
But it doesn't mean, 19 out of 20 of them might be completely irrelevant. Right? Does it correlate with returns? No. Okay. Well, what am I looking at it for? Well, that's the what I'd write about in the newspaper.
It's interesting.
Look, keeps me in a job.
All right. We should probably wrap up here. As usual, if there's any topic in particular you want us to cover off, please write to us. support@totalmoneymanagement.com.au or get in touch over the socials. Thanks for today, gentlemen.
Cheers. See you
Thanks,
next time.
Tommy. Thanks, Jacob.
Thanks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.